So I think that the consensus compares spending growth with credit growth. So when credit growth is strong, the consensus is expecting strong spending growth. And if credit growth is negative, they're expecting spending growth to struggle. Right now, we'd like to try to make an alternative argument. We would say credit growth.
Hello and welcome to today's podcast. Today we're unpacking a deceptively simple idea, but with one with outsized implications for markets. What we're talking about today is that it's not how much the private sector borrows, but it's the rate of change in that borrowing, what we call the credit impulse, that really matters. I'm Gemma Cairns-Smith, investment specialist at Ruffer, and today I'm joined by Mike Biggs, our head of macro strategy. And we're here today to discuss his article, The Road to Prosperity is Paved with Debt, from his 2026 Ruffer review. Mike, thank you so much for joining me this morning. It's great to have you on the podcast. Before we get in to talk about your theory and what it means for markets and the economy, you're relatively new to Ruffer, so I think it would be great for our listeners and our watchers at home if you could just introduce yourself. When did you join? Why did you join? What's your career journey been like so far?
Gemma, thanks very much for having me. So I joined Ruffer on the 2nd of April of 2025 as the Liberation Day speech from Trump came out. So it was a
great timing, a real time to join.
A really eventful start. My career started on the sell side at Deutsche Bank, where I played a range of economist roles, and I was an equity strategist and a rate strategist. I spent 12 years there, and then I wanted to move to the buy side. So I moved across to GAM, and at GAM I was a portfolio manager in an EM local currency debt fund. I was very pleased to join Ruffer. I think there are a lot of funds out there that try to manage money relative to a benchmark. And there are a lot of pod shops that will try and harvest risk premium of sorts. But Ruffer does something that's unique. It tries to take big macro views to, in the first instance, preserve client wealth and then enhance returns. And I think that's a very worthwhile endeavor.
Thank you. So let's get into the nitty-gritty of your article. And really, it's all about the credit impulse. That's what your article talks about. So can you just describe to me what actually is the credit impulse? And really, why is it something that other investors, other economists don't really pay enough attention to in your mind?
So in briefest terms, the credit impulse is the change in new borrowing by the private sector. If you think about it in credit growth terms, it's the change in credit growth. And why we think it's important is we think this is a credit metric you've got to look at if you want to understand what's happening to private demand growth. Yeah? Perhaps to give it a bit of context, right? So I think that the consensus compares spending growth with credit growth. So when credit growth is strong, the consensus is expecting strong spending growth. And if credit growth is negative, they're expecting spending growth to struggle. Right now, we'd like to try to make an alternative argument. We would say credit growth, you can have decent spending growth and negative credit growth. In fact, you can have very strong credit-driven spending growth and negative credit growth at the same time. Right, so hopefully that sounds a little bit counterintuitive. So how does it work? I mean, imagine in year one, you've got an income of 100 and you've got to pay down your debt by 10, then you can spend 90, right? If in year two, your income's still 100 and you've got to pay down your debt by 5, you can spend 95. So your spending's going up from 90 to 95, even as you're paying down your debt. You've got negative credit growth, strong spending growth at the same time, right? Just intuitively, how much you spend today has got to be a function of how much you borrow today. How much you spend tomorrow has got to be a function of how much you borrow tomorrow. So if you want strong spending growth, the amount you borrow has got to go up. It doesn't really matter how much you borrow. It doesn't matter if it goes up from -10 to -5 or +10 to +15. And this change in new borrowing, that's the credit impulse, right? In credit growth terms, it doesn't really matter whether credit growth's high or low. The only thing that matters is it rising or falling? Right, so why is it misunderstood? I think there are two ways to look at this. One, from an economic theory perspective. Economic theory has always been very, very poor at putting much emphasis on credit, on the role of credit in the business cycle. You know, after the financial crisis, the IMF wrote a paper saying that there were no central banks in the world that had a model that captured credit frictions and their impact on GDP growth. which seems disappointing, right? And the private sector, well, the errors you make when you don't follow the credit impulse, you see them most obviously when credit growth is, say, negative and rising. And this is not a very frequent event. Before the financial crisis, the last time credit growth was negative in the US, I think, was during the Great Depression. Right? So no one who was alive and working in the financial crisis was alive last time it had happened, basically.
And what are the origins of the credit impulse? How did you first come to explore it or to see it?
To see it, yeah. It's funny, I was in South Africa in 2007, and at that stage, credit growth everywhere in the world was really strong, and car sales were very strong. And in South Africa, car sales are very much driven by credit growth. They're all bought in financing. And I was chatting to someone, and car sales had been strong in 2007. And we were making the point that to have exactly the same car sales in 2008, you were going to have a lot of borrowing. Yeah. You were going to have strong credit growth, right? So you suddenly realized, wow, you've got strong credit growth just to keep spending growth flat, and then suddenly if there was any hit to that credit growth, then suddenly spending growth was going to come down. And what was quite interesting was I had coincidentally had a conversation with Henry Maxey earlier on in 2007, and he'd been expressing concern about the credit cycle and how the world is going to fall apart. And to be honest, I was a bit skeptical. I thought, look, investment levels aren't too high. Returns to capital look fine. Why should this fall apart? And then suddenly when we thought through this credit story, I suddenly realized what he'd been trying to say, probably 9 months before, which obviously proved correct. So that's how I came up with it.
And so is it a leading indicator? Would it be right to think of it that way? Is that how our listeners at home should think about the credit impulse? Should we be tracking this?
I mean, you absolutely should be tracking it, but it's not a leading indicator, I'm afraid. It has some leading properties. You can see sometimes people borrow and perhaps they spend a little bit in the future. But most of the time, if you spend on your credit card, the credit happens at exactly the same time as the spending. It's also true if you get a mortgage approval, but the mortgage comes through at the time you actually buy the house, right? So it's not a leading indicator, which raises the question. I mean, if it's not a leading indicator, what's the use for people in the financial markets, right? And we think it's still extremely useful because if the market understands the credit and spending relationship incorrectly, they're going to be prone to making systematic errors. So the idea we have in mind is, imagine you in Spain in 2013 and credit growth going -6. And the consensus view is credit growth is going to go from -6 to -4. But while -4 is less bad than -6, it's awful. Spending's going to be weak, right? We're in this sort of debt deflationary crisis. And if you're thinking of it from a credit impulse perspective, you're thinking -6 to -4, that's +2, spending's going to be strong. So even though you all agree on what's going to happen to credit growth, you've got very different views what's going to happen to spending growth. And if we're right about spending, then the market's going to be surprised positively and asset prices should rally.
So if we just go down a slightly different tact now, in your article, you obviously speak about the UK. Now, we've had interest rates coming down in the UK. So have we already seen the credit impulse play out there? What's next for the UK economy and how can we think about the credit impulse there?
No, that's a good question, right? I think we saw the hint of it, but we haven't seen it.
Okay.
So we had the rates coming down. And after the election in 2024, start of 25, you saw new borrowing going up. You saw a small increase in the credit impulse and growth in the UK basically surprised positively. Then what happened was you had stamp duty increase, you had national insurance of employers, and there was a sort of hit to the economy in Q2 and new borrowing flagged a bit again. And then again with the uncertainty around the election, new borrowing flagged a little bit. So new borrowing went up a little bit, and then it's flatlined since then. So we've had no credit impulse, and we've had pretty modest growth. But the level of new borrowing still is very, very low. So if we get some stability from a policy perspective, we've had rates coming down, I think the asymmetric risk is still new borrowing up from here, positive impulse, upside surprise to spending growth.
And what do you think could be the next catalyst for that, other than policy stability, as you alluded to there?
Yeah. Look, I think it's a combination of factors. I mean, the one is the fact that rates have already come down.
Yeah.
The second one is just some policy stability, as you say. The third one is that, because the private sector has been borrowing so little in the UK over the past 15 years, the debt to GDP ratio has come down. Their balance sheets are getting stronger and stronger all the time. Somewhere they're going to say, look, my balance sheet's strong enough now. I can afford to borrow, right? And then a final one, which I think could be very interesting, is a change in bank regulation. We've already seen at the end of last year, they started to ease on bank regulations. And maybe that could cause a rise in new borrowing. And
some of our listeners at home might be sat there thinking, but don't we need bank regulation? A lot of it was brought in after the GFC. Surely, bank deregulation isn't necessarily a good thing, or actually is it? How do you reconcile that tension between the two there?
Yeah, no, look, that's an excellent question, right? So I think we've got to see it in the context of the financial crisis. I think we have a tendency to think that borrowing is a bad thing. And firstly, I don't think that's right? Most of us borrow to buy a home. Firms borrow to do some investment, right? These are the things that drive the economy. Now, if you borrow too much, right, you end up being over indebted. You run the risk of a financial crisis. But if you borrow too little, then your economy is not going to be as dynamic as it could be. So you have the financial crisis in 2008. And regulators come in and they put in new bank regulations. And that makes absolute sense, right? So they don't want to have a financial crisis again. And the question is always, look, are regulations tight enough? And the alternative is, are they too tight? And if we look at what's happened since then, right, new borrowing has been very low in the UK for 15 years. We've had very modest GDP growth for 15 years. We've had very, very weak productivity growth for 15 years. And I think we've got to ask ourselves the question, doesn't that mean prudential regulations are too tight? Shouldn't we be easing them? And I think policymakers are moving in that direction as well, which is what we saw at the end of last year from the Bank of England.
So we're pretty excited about the UK and the concept of the UK credit impulse and what that could mean. How are we looking at implementing that in the Ruffer portfolio today? Have we put our money where our mouth is?
Yes. So we have. And obviously with all of these problems around the budget, etc., we haven't really got all of the upside from it yet. But I'm hoping that's still ahead of us. So what we've done is we've put together a basket of stocks that should be most exposed to rising new borrowing, interest rates coming down, rising new borrowing, strong positive credit impulse. And it contains pretty much what you'd expect, a couple of home builders, a couple of retailers, a bank or two.
And what about the situation in the US? Is that similar? Is that different? Is there a credit impulse positive surprise to come there too?
No, there absolutely is, right? So if I can give you a sense, in the UK, new borrowing after a recession usually is around 1 or 2% of GDP. It shoots up to 10% of GDP. In the recession, it falls back down to 1 or 2% of GDP. And since 2008-9, it's bubbled around at 2% of GDP. There's been no new borrowing. Now, in the US, you get the same sort of cycles, probably more amplified than in the UK. And what happened is borrowing recovered a little bit in the US to about 6% of GDP, but average new borrowing in the US is probably 12, and by the end of a cycle, it's normally 15, 16, And it's been bobbing around 7 or 8, and with COVID and with the rate hikes, it's fallen to 5 or 6. So I absolutely think it can rise in the US as well. And if it does, what we should see is a broadening out in this recovery, which so far has been very much consumer spending and investment linked to AI. And perhaps we can see residential, non-residential, durable goods spending all improve as well.
And so we're deliberately fishing in those areas.
We are trying to fish in those areas,
yeah. Nice. Yeah. And what's the biggest pushback you get to this credit impulse theory? Where might it go wrong? Why might it not happen? What are some of the discussions that you have on the investment team around that?
So I don't get the pushbacks from the investment team so much on the theory. What is originally is people look. It's intuitively it just sounds so sensible that negative credit growth should be bad for GDP growth. Positive credit growth would be good. So you'd make the whole argument, and everyone would listen and go yes. But by the end of the discussion, it doesn't change their views at all. But the difficulties here for us, I think, are twofold. Right. The one is, say, in the UK, new borrowing still has to rise. I mean, I think the investment's right because there's a real asymmetry of outcomes. I don't think new borrowing easily falls from 2 to -3, right? But it can easily go up from here. So it's asymmetric. But still, households and firms have to feel confident enough to borrow. Yeah, and I think they will, but that's the missing link
ahead
of us, right? That's the missing link, And then if I look at it in the US, not so much in the UK, but if I look at it in the US, the credit impulse argument, what it basically depends on is that the marginal unit of spending comes out of private sector borrowing, right? And that has almost always been the case for the last 35, 40 years. But what happened a little bit in 2002 was obviously the marginal unit of spending came out of fiscal. They'd given this huge transfer of cash to households and firms, and they spent it in 23, 24. So spending was a bit stronger than I would have anticipated. It can also be the case now that the firms that are doing all the capex are the firms which have got incredible free cash flow, right? So they don't actually need to borrow. They just can run down their cash flows. So all of these things, I think, just provide a little bit of a noise in the relationship, but it doesn't really change anything. If the new borrowing goes up, I think we'll see it in the stronger spending.
Mike, thank you so much. We're nearly approaching the end of our time together, and I always like to end these podcasts with like a bonus round. So I've got a couple of bonus questions for you. Linked to the fact that you're an economist, I wondered if you could let me and our listeners know, what's your favourite economic data point?
I mean, it's tragic that I've got an answer to that question.
I mean, that's very sad, Mike. We both know that.
So if I could only see one data point a quarter, it would be the Fed Senior Loan Officer's Opinion Survey. What that tells you is what's happening to credit conditions, how willing banks are to lend. And because of that, the Fed's survey correlates very, very well with the credit impulse.
Okay.
And because of that, it correlates very, very well with spending growth.
All comes back to the credit impulse.
Absolutely.
Beautifully linked.
And the great thing is that the survey comes out at the end of the first month of the quarter, and you only get the GDP number 2.5 months later. So that I think, from a timeliness perspective, is a genuine lead.
And then one more question for you before I let you go. What's a contrarian view that you hold on markets today? And you can't say the credit impulse because you've already said it.
I've already said that. Right. So my contrarian view is that for the range of interest rates we've seen over the past 40 years, I don't think the notion of R star of a neutral interest rate matters. People think if rates are above R star, that's a drag on growth. And if they're below R star, that's a stimulus. And I just think that that's absolutely wrong. The only thing that has mattered is really the changes in the interest rates. And the levels have had almost no impact on the economic outlook. But maybe that's a subject for a discussion on another day.
That definitely feels like another episode. Mike, thanks so much for joining us for your first Ruffer Radio episode. It's been such a pleasure to have you. And thank you, everyone, for listening and tuning in at home. If you've found our discussion today interesting, please do go and read Mike's article from this year's Ruffer Review. We've also linked it in the show notes from today. Thanks.